As Australia's housing markets charge through spring, we're seeing a fascinating contrast emerging. While the broader economy shows early signs of easing, the property market's powering ahead. The most recent ABS statistics show that unemployment ticked higher at 4.5%, which is a new cycle high, and employment growth slipped to below average pace of 1.5% a year. An underlying slowdown in the care economy, jobs growth affected this. But what does all this mean for our property markets? What does it mean for the Reserve Bank with its interest rate decision as we head into this final stretch for 2025? That's what we're going to discuss today. So welcome to another episode of Property Insiders, where Australia's leading housing economist, Dr. Andrew Wilson, and I take you behind the headlines to uncover what's really going on in Australia's property markets. Each week we share the data, the trends, the insights that the mainstream media often misses, helping you make smarter, more confident investment decisions based on facts, not fear. So whether you're an investor or a home buyer, or simply just property curious, this is where you're going to get the real story. Hello, Andrew.
Yeah, good day, Michael, and welcome to mid-spring, and we are right in the middle of spring now, so I guess everybody will be thinking about, God forbid, Christmas shopping, but...
Well, that's 2 months away, isn't it now? Now, Andrew, the latest ABS statistics showed unemployment rising from 4.3 to 4.5% in September, and the headlines started to cry out that now the Reserve Bank's got to drop interest rates, employment's at a cyclic high. Is this anything to worry about?
No, Michael, it's not, but it's a fertile ground for the clickbaiters, and they're out in force as usual, and we shouldn't be surprised at that. But, of course, we're a clickbait-free zone here, are we not? And we provide evidence-based insights into the property market, and that's what we're doing. But, yes, look, it was perhaps not a shock. Let's look at the big picture here, Michael. Our labour market has been tracking at unprecedented highs when we consider not just the unemployment rate, but the participation rate since the end of the pandemic. You know, business cycles are called that for a reason. They are a cycle. And it was inevitable that we started to see, given just how strong our labour market was or is, certainly a full employment labour market, that we would see some easing. And we've seen that slightly. But even when we take the headline result at face value, and that 4.5%, that's still a very low result in terms of the historical nature of our unemployment rates.
Chart here shows that it really is much lower than it was for most of the last decade.
That's right, Michael. And even when we go back to the very strong periods of growth that we did have, the periods prior to 2010, I guess we call that the noughties, don't we? Or the aughties.
Yes.
During the aughties, we had an unprecedented mining boom, very strong economic growth. Demand was well ahead of supply. We actually had the Reserve Bank raising rates towards the end of the aughties because demand was so strong. But even during that period, unemployment rate bottomed out at 4%, which isn't that much lower than where we've been over the past year or two. And even in the second mining boom, 2012, where Australia was recovering, where the rest of the world was continuing to flatline, our unemployment rate bottomed out at 4.9%. So I think history tells us, Michael, that anything with a 4 in front of it is actually a low unemployment rate, particularly in the mid-4. So that's just dealing with the headline rate, Michael. But we need to go deeper just to see whether this particular rate is a substantiation of a perhaps, as a lot of the media are screaming, an easing in the business cycle. It might be an easing, but it's certainly not a collapse, as some are suggesting, and of course are suggesting, oh, gee, we need more interest rate cuts. Because if we look at it closely, Michael, the Reserve Bank did mention that there were some issues around the seasonal adjustment numbers, that they are saying to take the seasonal adjustment numbers into consideration with this higher unemployment number. There have been issues with seasonal adjustment methodologies from the ABS in the post-COVID period. So I would suggest there's some issues over seasonal adjustment that need to be considered with that higher number. And when we look at the breakdown numbers, Michael, in the actual figures, jobs are actually up 14,900 over the month. And the previous month, where we had a 4.3% unemployment rate, we actually lost around 4,000 jobs. Now, the unemployment numbers increased by 33,000 over the month, and that's why we did get the higher unemployment rate. But the other reason for the higher unemployment rate was that the participation rate was higher again. So what that means, Michael, is more people came into the workforce.
Yeah.
So we find more jobs to maintain the same unemployment rate. So with more people coming into the workforce, that's always a strain on the capacity to absorb those new entrants into the workforce. And that also, as the ABS mentioned, was another factor in pushing the unemployment rate up. Now, people are coming into the workforce reflects a confidence in the actual jobs market that they can find jobs. But again, this is a seasonally adjusted outcome, and we need to take that with a grain of salt going forward. So, yes, there's certainly a cyclical high in terms of the headline numbers, but we need to wait for coming months just to see whether this again adjusts itself down into the low fours from where we are right now in the mid fours. But irrespective of that, and I would be surprised if we didn't see a downward adjustment, particularly coming through what is a stronger trading period in the end of the year, October, November, particularly strong trading months. Of course, we've got Black Friday coming up. We would expect to see more jobs created in that environment and therefore pushing down the unemployment rate. But again, it's about the participation rate, which is back near record highs, and also the seasonal adjustment, which the Reserve Bank says it is adjusting the seasonal adjustment numbers. So I think
There's
that's
nothing really to worry about. It's one
No.
of the many factors the Reserve Bank's going to take into account on Cup Day. But the big factor is also going to be the inflation figures,
Yes.
which are going to come in next week. And we'll discuss those when we catch up at the end of next week for our end of month report.
Yes,
One of
Michael,
the
but
other
I think just adding to that RBA insights without going into too much depth, because we'll do that later. I think this higher unemployment rate, actually, it might be a little bit of a relief for the Reserve Bank, because they are being asked very difficult questions now in regard to inflation, having missed their targets, and perhaps a higher unemployment rate just gives them some, I guess, capacity to say, okay, well, lower interest rates are needed or have been needed to support what could be an easing in the labour market. But it'll be a very interesting discussion and some very interesting results around the next RBA decision, which of course is on Melbourne Cup Day.
Well, the RBA recently came out and said, we're not worried about the property market either. Previously, they were a bit concerned
Yes.
about what was happening to property prices, but they're now saying that's not their focus anymore, Andrew.
Well, I think they'd have to say that, don't they, Michael? Because there's a lot of political pressure in regard to high house prices. We might even get 10% growth in the national house price this year, Michael, and the government's putting its money where its mouth is. Of course, we're getting tens of thousands this month of first home buyers coming into the market courtesy of the federal government's first home buyer scheme. And that can only mean higher prices, which will only impact affordability. So, as I said, I think the Reserve Bank is staying clear of what would be a very difficult argument in terms of housing affordability. And as we'll see shortly, and as we've been discussing for months and years, that there's no light at the end of the tunnel in giving us more houses to cater for all this extra demand that's coming through. And that's also being impacted by higher house building costs.
Well, house building costs have shot up over the last couple of years. They were very high post-COVID. Now, building cost pressures are easing, according to the latest figures from My Housing Market. I know you keep a careful track of that, but I think we have to understand what that means. It doesn't mean it's actually cheaper to
That's
build
right.
houses. It just means cost of construction isn't growing as fast.
That's right, Michael. And it was concerning recent months that we had started to see the My Housing Market house building cost index rising again after falling and plateauing as we sort of would have expected when all that energy from a couple of years ago, the previous government's home builder allowance, dissipated. But we did see certainly at the very least, some stickiness in terms of house building costs with that index number. But we've now seen over the most current month, we've seen, which was August, that house building costs, the index has actually fallen. But even with the fall, Michael, the index now stands at more than 50% higher than where it was prior to the COVID period. which is 4 years ago, but still 50% building costs over
Huge
4
cost.
years is quite significant,
Yes.
in absolute terms. So even though, as you suggested, the rate of growth has eased over the past month, building costs are still high and still offer an impediment, particularly to builders, of course, who have to pay these costs and have to consider that as part of their business decision making. And even though we've seen higher home building approvals, that doesn't mean that those numbers will translate into commencements because of the high cost of building that builders have to consider.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with one of the wealth strategists at Metropole to discuss your goals, your options, and what you could do? We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. Remember, property investments are process, not an event. So you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a home, go to metropole.com.au and organise a time for an obligation-free chat. You're going to find that at Metropole we're big enough to tip the scales in your favour, but still small enough to care. And since we don't have any properties to sell, our advice is independent and unbiased. Well, we know that one of the challenges is that most new developments are not financially feasible at the moment because of the high building costs, and that people aren't prepared to pay the high cost of new construction. It also means that any new construction is going to come at a much higher cost than established prices. So established good apartments have got quite some intrinsic value in them. Having said that, we're into the spring market, as we said at the beginning, Andrew, and the auction markets have been behaving strongly. They're in full swing with lots more properties coming up for auction every weekend.
Well, that's what we see, Michael, as the spring selling season progresses, and we are right in the middle of it now. We get more stock coming in that technically should offer more supply, therefore perhaps, putting downward pressure on clearance rates, but we really haven't seen anything of that. It's been an extraordinarily strong market this year, auction market this year, and of course that's translated, as it always does, to higher prices, and it's really been across the board. And it's interesting that some of those laggards in terms of auction performance, such as Melbourne and Canberra, have certainly revived, and even the Canberra market, which was stagnated really almost to the middle of this year, is now certainly up and running and providing good results for sellers. But this is the time of the market where we do see the highest numbers of new listings coming in. Of course, this weekend, Michael, we will have the second Spring Super Saturday, and that, of course, is the weekend before the Melbourne Cup break, which most markets tend to follow in terms of avoiding vendors and agents avoid that period in terms of putting their auctions up, so they front end loaded, I guess we could call it, over the weekend before. So we're going to see, likely as usual, record numbers of properties coming into the market for auction this coming Saturday. So that, of course, technically means a lot more choices for buyers, a lot more competition for sellers. But we have had that similarly over the last couple of weeks as we've recovered from what was a holiday period at the end of October, through October, but it's had no effect at all on the auction clearance rates, Michael. As I said, onwards and upwards. And I think we've still got plenty of momentum in our housing markets from that last interest rate cut, October. It takes some time for that to work. And I do think we're going to start seeing, particularly with all that demand coming from first home buyers, taking advantage of that policy, the government's policy enacted in October, that's going to continue. And I think we're also starting in some markets to get a sense of FOMO, fear of missing out, bringing forward demand because prices are rising. And if we could just give you a mid-month sneak preview, we're starting to track some very strong prices growth through October. In the context of already having had strong prices growth this year, it's looking like October will exceed most of the other months, if not all of the other months, in terms of home price growth, which is no surprise given how strong our auction markets have been. So perhaps we should have a look at the results from last week Michael, while we're speaking about that. So, yeah, we had more auctions coming into the market and building up towards that Super Saturday this weekend. But clearance rates remain generally strong. And as I mentioned, the auction markets will face technically their biggest test of the year, likely next week or this week coming through with that final Super Saturday, Spring Super Saturday of auctions with those likely record auction numbers, auction of properties going under the hammer. So Sydney had 1334 auctions, big number for Sydney last week. The clearance rate holding steady at 76.1%. That's clearly a seller's result, Michael. When your odds are just under 80%, 8 out of 10 properties going under the hammer, that can only mean higher prices and well ahead of the same week last year, and the clearance rate also higher compared to the same week last year. Melbourne, similar auction numbers over the week, but Melbourne will have very big numbers this week coming up, Michael. 1,122 in Melbourne. Again, a very steady clearance rate, 74.1%. Again, 10% plus clearance rate improvement on the same week last year, and higher auction numbers. Big surge in auctions in Brisbane, 184 auctions in Brisbane. Brisbane down to 44.8%, but we know that Brisbane market has its own, local measure of market activity in relation to clearance rates. Adelaide also higher auction numbers. It had a bit of a dip last week, Adelaide, with a 65% clearance rate. It's been tracking up around 80% recently, Adelaide, and back near that 80% mark from 133 auctions, Adelaide 76.9%. And that Canberra market has certainly now consolidated its revival. We can clearly call that. Similar auction numbers in Canberra last week, and a 68.7% clearance rate in Canberra. And you just see the difference over the year in Canberra, Michael, where a year ago its clearance rate was 55%. And when we look at the trends, the monthly trends over the past year, we quite clearly see the revivals in every one of the capital city markets following those interest rate cuts in February, and a rising energy really through the spring period as well. And as I said, we've got a big test coming up, particularly for the Melbourne market, but all markets this weekend, which will again host high numbers of auctions. But I think that given all the recent evidence, and really that evidence goes back to the beginning of the year, or certainly after the interest rate cuts, that we'll continue to see those high clearance rates. If you're looking for the latest auction results, Michael, of course, you can go onto my LinkedIn channel, which is Doc Andrew Wilson at LinkedIn. Every Saturday night, we release the headline results at around 6 p.m. And of course, Michael releases the full national report, which includes regional breakdowns for Sydney and Melbourne, and the top 10 sales under the hammer for each of the capital cities over the past week. So look out for that on Michael's various channels. So another big weekend in auctions. It's interesting time of the year, Michael, because once we move past the Melbourne Cup period, it's into the final, I guess we'd say, period of the spring selling season. It does become, if anything, a market where buyers are more active and sellers become more motivated, obviously, to clear their stock before the Christmas break. So it'll be interesting to see how it occurs that next phase. But this is the meaty part now of the market this coming week. So there's going to be a lot of people who will be securing a new home, Michael.
Well, we're finding on the ground that there is strong depth in the three big capital cities where Metropole operates. And even in Brisbane, even though there's not a lot of auctions, like you said, boy, there's large queues for the various properties up for sale. People are buying quickly. There is a sense of FOMO in the market as prices are getting away from buyers. So look forward to catching up again next week. And at the end of next week, we'll have our end of month report. And you've already given us a hint, some good news for those who own property, and maybe some news for those who are looking to get in. Do so before the prices get to the next level.
Well, that's what FOMO is all about, isn't it, Michael? You know, you've got to avoid those, seems to be almost inevitable price rises now. And this is certainly a very strong period. And as I said, I think we've got a chance of getting a 10% growth in capital city weighted average house prices this year. And that'll be the strongest we've had since the bounce back post-COVID period.
And that's despite no interest rate falls for the last couple of months, and maybe not another one this year at all.
I think lower interest rates are still driving the market, Mike.
Oh, yes.
I think that energy is still to be fully taken advantage of.
Way through.
Yeah.
Definitely. Sure. Look forward to catching up next week, Andrew.